What's up, guys? Welcome back to This Just In. Thank you for joining me today. In this video, I'm going to show you some really nice recovery stocks that I think will do well over the course of the next 12 to 24 months as we get out of the pandemic and start to get back to normal. So let's not waste any time and let's jump right in. Alright guys, so first things first, this video is for entertainment purposes only. I'm not a licensed stockbroker. Always do your own research and due diligence. Before we get started today, subscribe to the channel, hit that bell notification so you can stay up to date. I post new videos every day. And then also like the video if it gives you any value. That helps the YouTube algorithm and I really appreciate it. Real quick, I just want to say thank you guys so much for everybody that's been subscribing. It means the absolute world to me. You have no idea. So there's also a link down in the description to my Patreon account. Come join me over there. Come be a part of the family. You'll have access to the private Discord. We can talk stocks all day. You'll also get links to my different portfolios over there so you can see exactly what I invest into. And then anytime I buy or sell a stock, I will send out a notification so you can see what I'm doing when I do it. Anytime I have, alerts or, entries or anything like that, I send that out the second I do it so you can see that. There's also a link to Webull. Set up an account, deposit $100, you'll get some free stocks, and then I get a free stock as well, so it helps support the channel. But let's jump right in. So, with how bad the market's been getting, pretty pounded down and brutalized the last couple of weeks on this big correction, I've been thinking, what can I do to find stocks that will give us an opportunity to be diversified, but also give us the opportunity for growth, moving forward. I obviously love investing in growth stocks. That's why my portfolio got so hammered during this correction. So I've spent a ton of time, in the last week or so researching as much as I can, trying to find some stocks that I think will do really well in recovery industries like travel, commodities and things like that. Today we're going to be going over travel, and I've got 3 stocks for you that I think can give us some nice gains. So the first one we're going to take a look at is SAVE, which is Spirit Airlines. The reason why I chose this airline over a lot of the other airlines is because I like the fundamentals. So right now, Spirit Airlines has a $3.5 billion market cap. Their revenue in 2017 was $2.5 billion. In 2018, they jumped it up to $3.2 billion. In 2019, they jumped it up to $3.7 billion. And then in 2020, they only did $1.7 billion. And obviously, all the travel stocks got absolutely killed in 2020. But I really like that growth from 2017 to 2019. Their gross profit in 2017 was $949 million. Then they jumped to $1.1 billion in 2018. And then in 2019, they did $1.3 billion, so a little jump there. But then they lost $178 million in 2020. Their PE ratio in 2019 was 8.2. Really nice PE, undervalued. Obviously, their PE right now is negative because they're negative in earnings. Their price to book ratio in the trailing 12 months was 1.56, where the sector median's 3.1. So there's pretty nice, price to book ratio there. Their forward price to book is 1.98, where the sector median is just under 3. So they've got a little bit of a better price to book than a lot of the other, airline companies. The other thing that I liked is their working capital growth is 270% year over year. So they're maintaining through the pandemic, and I think that they're positioning themselves to really have a strong comeback when I think a lot of the other airlines will take longer to get there. The other thing that I liked was their forward earnings per share growth rate is 92%. Expected 92% over the next 3 to 5 years. So they're really, expecting to have a huge, recovery, jump right back into it and start to grow that earnings per share, really significantly over the next 3 to 5 years. The airline is really back in growth mode, at this point. They're looking to get back to full capacity in 2019 levels by mid 2021. So we're getting there. You know, we're in the third month of 2021, so in the next 3 months, you know, they're looking to be at full capacity of 2019. That's nice, you know, pre-pandemic levels. Spirit Airline also wants to run 20% additional airplanes in 2021. So they want to run 20% more airlines in 2021 than 2019 due to like increased deliveries and things like that. They are actually expected to be adding 16 different airplanes to this year to bring the total to like 173, and then move that number up to 190, you know, planes by 2022. So they're really taking a model of huge growth, you know, trying to really get back into it, you know, and bounce back as quickly as possible from the pandemic. So they're adding planes, you know, they're trying to get back to max capacity. And I don't think the pandemic is fully over yet. I still think we will have some, you know, restrictions moving forward, but I do think it's inevitable that we will get back to, you know, to normal, you know, within the next 6 to 12 months. Let's take a look at the chart. As you can see, you know, if we take a look at the daily chart, back in, you know, pre-COVID, we were, you know, we had a high of like, you know, $47. You know, back even before then, back in the, you know, middle of 2019, we had a high of, you know, $55. So you can kind of see, you know, back here in 2019, they were doing really well. You know, this share price up around $63, and, you know, got beat down in COVID, obviously, just like every airline. You know, I usually don't like to invest in airline companies because airlines rough business. You know, they really expensive maintenance cost, you know, delayed flights, weather restrictions, you know, so many different loopholes and things you've got to jump to make everything work together and be successful. But I do think that Spirit has a lot of things going for them, and I really like the aggressive, you know, growth approach. I really like how they're trying to really jump back into it, add more planes, you know, get back to normal, where a lot of the other airline companies are, you know, having smaller fleets all the way up until like 2022. Even though it's only deliveries is why they're adding a lot more, you know, planes, I still like that. Still like that they're trying to do everything they can to get it back to where they need to be. So, and I think that they will start to kind of get that revenue back to where it needs to be over the course of the next, you know, year and a half. It's going to be a slow recovery, but if you can be patient, like you should be with all of your investments, you know, getting back up to this $46 mark, you know, gives you nice growth. Just to get back up to, you know, those previous highs, you know, you're looking at around 40%, which is really nice. Then if you're talking, you know, 2019 levels, you're almost looking, you know, 100%. So I like Spirit Airlines. I currently have it in my long-term dollar cost averaging portfolio. I do own this stock, and I have done well with it since I initially started investing in it back, you know, last year, like around August, November, so, or August, October. So next one we're going to take a look at is AVIS car rental. I wanted to choose a different, you know, I wanted to give you 3 different types of travel, you know, stocks. Now, AVIS, the ticker symbol is CAR. Their revenue, they're a car rental business. If you don't know what AVIS is, you know, one of the bigger car rental businesses. Their revenue was $8.8 billion in 2017, $9.12 billion in 2018. Then they jumped it to $9.17 billion in 2019. So not a huge growth, but steady growth there from 2017 to 2019. In 2020, they got killed. They only did $5.4 billion. Their gross profit in 2017 was $2.3 billion. Then $2.5 billion in 2018, $2.6 billion in 2019, and then down to just a little over $1 billion in 2020. But their gross profit margin grew 18.9% year over year. That's nice. I like to see when you have gross profit increasing. Their net income was $165 million in 2018. And then it grew to 302 million in 2019, but then it fell to negative 684 million in 2020. Their cash from operations was 691 million in their trailing 12 months. But with that being said, that's a huge loss. Going from 300 million to doubling it the opposite way. That's a brutal beating that they took, but they've weathered the storm, and I think because of that, it's giving them the chance to have huge opportunity moving forward, because analysts are going to see that, even though it's going to take them a while to probably get out of the negative, get out of the red. I think analysts are still going to see that as nice growth, getting back up to the positive side of earnings. Their price to sales ratio was 0.79 in their trailing 12 months. Where the sector median was 1.65, and then their price to sales on a forward basis is 0.6, where their sector median is only like 1.5, or is 1.5. So they are doing much better there than a lot of the other car rental companies. Their forward earnings per share growth rate is projected to be 87% in the next 3 to 5 years. So they're expected to really scale their growth, their revenue, their earnings per share up pretty tremendously over the next 3 to 5 years. Again, these stocks you've got to be patient with a stock like this, or a stock like Spirit, or the next one we're going to talk about, because when the pandemic hit, they got just absolutely walloped, and this isn't something that's going to jump right back in a month, because COVID's not going to jump right back in a month. We're not going to recover in a month from COVID, but over the course of the next 6 to 12 to 24 months, we will start to recover. Everybody will start traveling again, and spending more money, going out, going on vacation, and it positions these companies to have a slow, nice, steady recovery that I do think could happen, quicker than a lot of people think, if everything goes well with vaccines and everything like that. Texas just opened up, which is huge. That's one of the biggest states, obviously. And so, depending on how the rest of the country reacts to that, depending on how well they do with their opening, I do think that you will start to see the travel stocks start, heading back up, in revenue and capacity in the next, by the end of 2021. Let's take a look at the chart. These guys are actually reaching all-time highs, back before the pandemic highs. So back before the pandemic started, they saw a high just right before the pandemic of 52. They are currently sitting at 59. So you're obviously getting that preemptory run, back up towards the upside in hopes of getting back to normal. The vaccines are coming out. People are seeing that, and they are starting to accumulate these travel stocks. You can see here just big pops the last week and a half, 2 weeks, and they really haven't been getting annihilated like a lot of the growth stocks have been during this correction. We look at a lot of the other EV stocks. You look at their last 2.5 weeks, it's just been straight down. I really like how you've got your moving averages curling up here. I like this chart. I do think they are a little extended, sitting up here at $59. Usually you don't want to buy a stock around all-time highs. I do think it might come down here and fill this gap. I don't know though, we'll see. But I do think that if you are patient, you plan on buying this stock and holding it for the long term, you will do well with it. Again, you've seen how important it is to be diversified, on big corrections like this. And travel and banking stocks, they are a really nice thing, commodities to have in your portfolio when you are getting a big pullback like this. So they are down a little bit on the last couple of days. It looks like they are, making a positive day today. So we'll see how they end up. But I do not own this stock, by the way. I am adding it to my long-term growth portfolio this week. I'm going to, this week or next week, depending on when I can find a nice entry, based off of, if we, pull up a monthly chart here, try to find some support and resistance. So it looks like back here, You know, 2014 they were up around 65. So it looks like you're going to have some resistance probably at 67. Yeah, but other than that, yeah, looks like they're up there pretty high. So yeah, I would probably wait until you could get a little bit of a, you know, a little bit of a pullback in the next you know, week or so, well, depending on how the market goes. But I would have no problem accumulating this stock if you plan on holding it for the next 12, 24, you know, 36 months, 48 months. So next one we're going to take a look at is LIND, which is a cruise line. Now, the reason why I chose LIND, this is a ticker symbol LIND. The company is actually LIND Blod Expeditions is the name of it. But the reason why I chose this one over like Carnival or Norwegian or any of those other guys is because I like their business model a little bit better. They are not, you know, a massive cruise line like Carnival is. You know, these guys focus on more excursions and adventures versus like you go on a Carnival cruise, massive cruise ship, thousands of people, really event driven, you know, nightclubs, comedy shows, you know, really fancy dinners, things like that. Where these guys are more like, you know, smaller cruise ships, 100 people, and, you know, it's more excursion driven. So, you know, going out, seeing Alaska or going to exotic places and going on, you know, land excursions. They have a partnership with National Geographic and things like that. And so I like that because I think post-pandemic, it's going to be harder to get back to cruise ships with thousands of people on them, and not as hard to get back to cruise ships with hundreds of people on them. Their revenue in 2017 was $266 million. In 2018, it was $309 million. 2020, it was $343 million. And then in their trailing 12 months, they've only done $157 million. So again, beat down. Their gross profit was $131 million in 2017. In 2018, they did $156 million. 2019, $176 million, and only $53 million in their trailing 12 months. So again, nice steady growth there. It's not, you know, walled up. You know, one year they go from you know, 10 million to 500 million. It's just nice steady growth. I like to see that. Their net income in 2017 was actually negative 8.7 million. But in 2018, they jumped it clear up to 11.4 million. That's nice. That's really, really nice growth there to get your net income that much higher when your revenue wasn't that much higher. You know, they must be doing a lot of things to save cash, you know, be more efficient, things like that. And then in 2019, they jumped it to 16.4 million, but they have lost 70 million in their trailing 12 months. So again, just absolutely destroyed there. Their revenues are down like 69% year over year, considering their previous reporting, and they had record passenger levels between January and the early part of March before their operations were shut down. So that, you know, they were on track to do very well. That's again why I like these guys, because right before the pandemic, they were reaching record passenger levels. You know, that shows how well their company was growing, you know, to do that. Prior to the pandemic, they were looking at revenues of like 405 million in 2020, which was going to be 18% higher from the like the 343 million that they did in 2019. Over the past 10 years, they've achieved like 13% compound annual growth rate. So it's not massive. They're not growing at 50%, but they're growing steadily, like I've said, and it's sustainable. I like sustainable growth. You'll see these companies come out and grow 70% one year and then 10%, 20% the next year. It's not sustainable. I like sustainability. They're also their revenue was 17% compound annual growth rate within the last decade as well, I believe. And then their adjusted EBITDA has reached 67 million in 2019, which is, which is nice, especially the fact that they've got really strong capacity rates, along with they were climbing their total number of guests, in the right direction. So they were growing revenue, they were growing passengers, things like that. Really nice to hear. I actually I took down a press release here so you can kind of hear what they say. What they said in their press release was the company has substantial advanced bookings for travel in 2021, and despite increased cancellations for travel in the first quarter of 2021, total bookings for 2021 are up 4%, or are ahead 4% of bookings for 2019 as of the same date in 2018, and only 12% below the same date a year ago for 2020. For the last 9 months of 2021, bookings are 12% ahead of the bookings for the same period in 2020, as of the same date a year ago. The company continues to see new bookings for future travel, including over 44 million since March 1st, 2020, and it is receiving deposits and final payments for future travel. These guys are an expensive cruise line. They're not like the $300 cruise for Carnival Cruise Line. Again, the reason why I like these guys, they've only got 9 company-owned ships, and the capacity is usually only around 100 guests. Like 100 people can travel on their ships. With that being said, in order for them to expand their fleet, their ships are 150, I think 200 million or something like that, where a new ship for Carnival Cruise Line is like $1 billion. So they can, it's a lot more manageable, when you're trying to come back from a pandemic like this. So I do think that they can jump back really quickly. I'm going to read you one more press release and then we'll look at the chart. So while it is uncertain when the company will return to operations, it believes there are a variety of strategic advantages that should have enabled it to deploy its ships safely and quickly once travel restrictions have been lifted. The most notable is the size of its owned and operated vessels, which range from 48 passengers to 148 passengers, allowing for a highly controlled environment that includes stringent cleaning protocols. The small nature of the company's ships would also allow it to efficiently and effectively test its guests and crew prior to boarding, which is huge. When you think about a Carnival cruise ship or Norwegian or any of these other guys, it would be extremely hard to manage social distancing, testing, cleaning, on their cruises. When these guys, you got 148 people, it's extremely easy to maintain social distancing and testing. And so it will give these guys a huge advantage to get back to full capacity over those other guys, even if restrictions continue to be pretty stringent and not open up as quickly as we all would like. Like I said, their average price for a trip is $13,000 per guest, and they generated a net yield of $1,100 per guest, which is like, I want to say 7 times higher than Carnival and 6 times higher than Royal and Norwegian. And so because their fleet is smaller and they can't hold as many people, they still make 7 times more per passenger. So again, I like this company. It's it may not be a super exciting, really fun stock to invest into, but it's in my opinion a really nice recovery play. I also think that it is kind of a company that has nice growth rate that will give us good, consistent growth and gains over the course of the next 5 years. You've got to be patient with stocks like this. I really like what they're doing. I like their plans for expansion. I like the partnership with National Geographic, and because they market for them, they do land excursions as well, which also made up like 15% of their revenue in 2019. Their land excursions did. So if we look at the chart here, they actually are past previous highs when the pandemic started, and looks like they are selling off pretty heavily today. Looks like they're down about almost 9%. So that's everything's kind of selling off right now. Maybe we'll find some support right here at the 1830 level, but we'll have to see. I do think that as the course of time goes on, the next 12-24 months, I do think that you could see this stock up around 25 bucks. I don't know how quickly it'll get there, but I think that as they start to get back to normal, they start to get back to positive revenue, positive income, that you will see the stock price reflect that. It hasn't been getting beat up as bad as a lot of the other stocks, the last couple of days or the last week. You can see it, it pops up, sells off a little bit, comes back up, sells off a little bit, and it's been maintaining this level right here, which is nice. You're not seeing it just on a steady decline. It looks like we are getting a little bit of divergence right here. No, never mind. Nope, sorry. We're not. Maybe right there a little bit now. But anyways, with that being said, guys, I wanted to try to give you some stocks that you can invest into, be patient, put in your portfolio, diversify, and over the course of the next 12 to 24 months, hopefully get some nice steady, gains that will help supplement some of those growth stocks and other stocks that you've got in there. I do also, like commodities. I will put out a video in the next couple of days on commodities. Semiconductors, I've got a couple of videos coming up, banking stocks, but I wanted to give you travel today because I think they can have a nice recovery. So if you've got any questions, put them down in the comments. I love answering questions with you guys. I love talking with you guys. If you have any ticker symbols you want me to cover, let me know in the comments. Come join me at the Patreon. I'm actually going to be doing a couple patron-only videos here soon, going over my exact swing trading strategy and how I find my swing trades and how I enter them. So if you want to see that, come over, join us, come, talk with us, hang out with us in the Discord. But that's it for today, guys. If you guys need anything, have any questions or anything like that, feel free to ask me. Thank you so much for watching and subscribing. I love you all. I'll see you guys in the next video. Peace.